see what's manageable. Maybe like 20 minutes, 25 minutes. Yeah,
Yeah, I think 20-ish is great. Yeah.
20. Yeah,
Yeah.
yeah,
No, I mean 20-ish, like
yeah.
not
20ish,
too much,
plus
not
or
too
minus.
little. Yeah.
Yeah,
Yeah.
yeah, yeah. Not 40. Yeah.
Right.
All opinions expressed by Chris, Michael, Zach, and their castmates are solely their own opinions and do not reflect the opinion of 5i Research. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
Welcome everyone to the first episode of the Exponent with 5i Research. My name's Chris White. I'm the Senior Investment Analyst with 5i Research. And today I'm joined by my co-host, Michael. Michael, do you want to introduce yourself to everyone?
Okay. Hi, everyone. I'm currently working as an investment analyst at 5i Research, and I've been with the firm for a while. I have a tremendous interest in stock picking and stuff, and I'm here to talk about it.
Nice. Yeah, no, definitely. Glad to have you as my co-host for today. And so, on this podcast, we're really aiming to bring Canadian investment research to our listeners, providing insights into individual stocks, the markets, economic insights. And so with that said, first episode here, what are we going to be talking about today, Michael?
So, first of all, we're gonna talk some about macro, then some of the names that we have been a big fan of over the years at 5i, and it's been like a huge winners for our subscribers. Also talking about some Canadian small cap names that you and I like recently. Also, the earning season is coming, so definitely that's a topic to talk about. Yeah, I think that's pretty much it for today's podcast.
Yeah, no, definitely. Yeah, it's a good episode that I think we've got lined up here. We have lots to talk about. It's start of the new year, and so always excited to see where the market heads. So, first we're going to go into recent news. So talking about macro, stock specific news, things like that. So, over the past couple of weeks, we've had the CPI and PPI prints. So for the US, we saw CPI come in a little bit hotter than expected, 3.4% versus 3.2. And then core CPI was 3.9 versus 3.8%. So the markets fell a little bit on that day, but overall, we're just seeing like the reaction to these CPI prints really be muted. And so investors aren't as concerned, on the inflation front as they once were, especially early in 2023. So that's definitely good to see.
Yeah, there may be some like volatility along the way, but the underlying trend is like downward, which is good.
Yeah, exactly. I think everyone's kind of now been reassured a little bit that the trend is down, disinflation's coming through, and we don't have to worry so much about reacceleration of inflation down up to 9% again. And then on the Canadian CPI side, we saw headline CPI come in about just matching estimates, so 3.4%. But what I found really interesting is that core CPI is coming in at 2.6% versus previous 2.8%. And it was actually deflationary on a month over month basis, down about 30 basis points. And so what I find interesting is the core CPI of 2.6% is pretty, like that's a pretty good number. I'm gonna throw up on the screen here the Canadian core inflation rate graph, and we can see, a massive acceleration into 2022, upwards to about 8% or so. But since then, it's been cratering down to 2.6 today. And we can see the average is around that 2% range, to something. So, we're certainly heading in the right direction. And 2.6% is really not a horrible number, and
Right.
I think it would take a lot to see reacceleration from here. So, yeah.
Right.
Yeah,
Yeah, it's still slightly above like historical averages, but like not but like the downward trend is there, and it's not far like to be normalized in the near future.
yeah, yeah, definitely. No, I agree with that. And then lastly, on the macro side, we just had some jobless claims. So U.S. initial jobless claims came in at 187,000, less than the expected 207,000. And Canadian employment was also positive. So this is again just kind of demonstrating that employment's remaining resilient, labor market's resilient, and that bodes well for the economy and job strength. And we're seeing disinflation on the inflation front, but while the economy is still strong.
So the next part, we gonna talk about individual stock and what we are good at FII, I guess. So here's a list of high quality Canadian companies that we have been a huge fan of over the years. Yeah, some of them make like big money for our members. Like for example, CSU is basically one of the best performing stocks in the Canadian market in the last 10 years. So we first added a name to our model portfolio back in 2014, and since then it has been up more than 2,600%, or around 27 baggers. Um, and unlike now, CSU back then was not as well known as it is today. Most investors back then were skeptical of acquisitive companies, and the concept of serial acquirer was not as well known as it is today. And most investors are just skeptical of how can such company keep executing by acquiring small software businesses year after year and keep compounding like a machine. and and actually the concern for investors back then was very similar to now. Like investors are also really worried that how large is the addressable market, and if CSU could continue to redeploy most of the cash flow back into acquisitions. But so far, CSU has proved doubters wrong, and we have been a big fan of CSU's management. We highly recommend investors to read the shareholder letters of CSU CEO Mark Lohner, which will provide investors insight into how management think about capital allocation, reinvestment, and the attractive unit economics of vertical market software. And as we can see in the slide here, so basically the revenue growth of CSU in the last 10 years was similar to a hockey stick, like 22% a year on average. And the beautiful thing is like the share count is basically flat. Um, and unlike other SaaS software companies, CSU did not issue stock options at all. And most of the shares are held by insiders that and they purchase it in the public market, similar to us. So it has been a pretty fair structure at CSU. Also, the share price has been surprisingly resilient. Uh, the largest drawdown in the last 10 years was never more than 20%. So this is indicating that CSU do possess a really high quality shareholder base who think like long term and acting like business owners, not traders moving in and out. And CSU continue to be the largest position in our balanced portfolio model at FII, and we expect to own it for many years to come. And the second name that at FII we have been talking about recently and have really endorsed it to our members is Lumine Group, which is also um, one second. Let me change the slide.
Yeah.
Okay. So Lumine Group, which is also a serial acquirer company that was spun off from CSU in 2022, and so they mainly operates in the telecom and media industry, and Lumine recently gained meaningful traction from mainstream investors, especially after they announced the deal that they will acquire the device management from Nokia, and the purchase price is around 185 million euro, and investors perceive this transaction very positively, and share price has been up almost 50% since the deal was announced. um, yeah, it's still a very early days for Lumine, but there's only one thing that I want to talk about here, which I don't think many investors discuss about it enough. So the 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 complex capital structure of CSU spin-offs really confuse investors. For example, like when Topicus was spun out of CSU, they possess a very complex capital structure that confuse investor about the number of shares outstanding. And Luman is very similar situation. And I just want to explain in details this part. So for some of the softwares out there, they show Lumine's market cap was around 2.5 billion. But actually, on the fully diluted shares outstanding is much more than that. And here's the calculation. So the fully diluted shares outstanding is around 253 million shares based on their prospectus. And the current share price today was around 33.4. So the market cap was around 8.45 billion Canadian dollars. And the market is expecting that 2024 EBITDA was around 330 million Canadian dollars. So the multiples in terms of EV to EBITDA for Lumine is currently around 25 times compared to CSU, which is around 24 times. So Lumine is trading at a slight premium to CSU. And I think this could make sense because the company size is still small, and Lumine can very likely replicate the playbook and the performance of CSU if management continues to execute well. Yeah,
Yeah.
and yeah, what and
Yeah.
what are your favorite names, Chris?
Yeah. No, it's I got a couple names here from Five Eye that we tend to like, and we think have strong management teams. But just interesting on Lumine there, being so much smaller than Constellation Software, but in a slightly different industry. Yeah, I feel like it does have the ability to grow, at a slightly faster rate and kind of replicate the playbook from CSU. So it's a really good point. And then on CSU, it's almost like sometimes I think about it as, kind of an addition to the Magnificent Seven. It seems like if you could add it, that would be one of the names probably to go into that same grouping. It's just been so strong. It's like the only Canadian stock that's really been similar to the performance of the Mag Seven from the US. So
Right, right.
it's a
CSU
really
is a outlier for sure. Yeah.
yeah, complete outlier in the Canadian market. So it's a great stock. Yeah. Okay, cool. Yeah, so I've got a couple names here. They're also connected, similar to yours. Add mine here. So yeah, today, so I'll be talking about Brookfield Asset Management. So the ticker is BN for Brookfield Corp, and then BAM for Brookfield Asset Management. And so previously, these were just one company, and then it spun out part of its business in late 2022. So Brookfield Asset Management became its own company. The ticker is BAM, and then Brookfield Corporation (BN) basically is the holding company. So Brookfield Corporation is a holding company. It owns stakes in different companies, including 75% in BAM. And it really acts as like the direct investor in real asset projects, so infrastructure projects, other things like that. And then BAM, being more of like the asset management company, really just collects management and performance fees. Um, and then it aims to distribute like the majority of its fees actually and its earnings as dividends, while Brookfield Corporation (BN) is going to retain most of its earnings to reinvest, go into new investments for different holdings, and um, and try to compound its capital that way. So one way that we've kind of thought about Brookfield, the different entities now, is that BN Brookfield Corp can really be seen as like a high growth entity, focusing on growth, capital allocation, investing in projects. While BAM, more of like the cash flow generator. It's really well suited for income investors because they're going to be distributing the majority of their cash flows out. Um, and then, I've got a graph here for Brookfield Corporation, and I'll just go through the various different pieces and then kind of talk about like where Brookfield is today, basically in the markets. So at the top, we see its EBITDA on a last 12-month basis, and this is over the past 10 years. So we see that it's been, expanding nicely. Its EBITDA has been growing, and the purple line shows its share price. And shares have really trended sideways over the past year or so, and that kind of makes sense with the high interest rate environment that we've seen, and with real estate names really kind of suffering over the last little while. Um, but yet its EBITDA continues to expand, and that's pretty encouraging for Brookfield investors. Then looking at the middle bar graph here, we have free cash flow on a last 12-month basis. And we can see really free cash flow did kind of decline and show a contraction there in the past couple of years, alongside the rise in interest rates. But as investors, if one were to believe that rates are peaking and rates are going to be coming down, it's reasonable to assume that Brookfield can increase its free cash flow once again, and see its share price kind of increase in line with that and start to reinvest into different projects. And then lastly, we have its ROE. Again, contraction, but this isn't the first time Brookfield's been through this. They have a really strong management team. They know what they're doing, and it's quite likely that we see some of that cyclicality return to the upside. So that's kind of my case for Brookfield. Um, Really strong company, and we've even seen the stock, perform a little bit better recently. So certainly
Right.
encouraging.
Right. Yeah, and the only thing that I would add there is like they are compared to as like the Berkshire of the Canadian market.
Yeah.
So it's been highly valued by some of the most senior investors out there. Um, yeah, and I have been a big fan of the CEO Bruce Flatt too. I've been reading like his shareholder letters over time, and I also highly recommend it for investors.
So what do we got up next? We've got kind of our Canadian small caps segment here. So Michael and I will be going over a couple of small cap names within the Canadian market that we like and have piqued our interest recently. So Michael, do you want to kick us off here with your pick?
Yeah, definitely. So one of the key indicators that we really like at FireEye is the company's share price that keep hitting 52 weeks high. Uh, we think it is a pretty powerful signal, and the logic is pretty simple. So great companies most of the time will be trading at 52 weeks high rather than lows, and great compounders will just keep getting to the new valuations, the new highest valuation. Um, and it is also a strong signal that something is going right at the company. For example, management may be improving the business better than expected, or the company is growing earnings faster than the market expects. And based on that indicator, we also tend to look for companies where their fundamentals are improving and growing faster than the share price indicates. For example, a name that we liked and recently added to our model portfolio is Terravest Industries. The ticker is TVK. The company is also a serial acquirer, similar to CSU business model, and company's acquisition targets are highly diverse. So their portfolios of businesses, including some of their market niches like agriculture, energy, transportation, mining, etc., etc. Fundamentally, TVK looks highly attractive. Revenue and EBITDA grew on average 20% in the last 5 years, and they have strong balance sheet and solid track record of acquisitions. And in their annual report, TVK's management also signals to investors that one of the uh, key objectives of their business is to grow free cash flow per share. And I think it is a highly strong signal for a capable management team to use that language. And the company is still pretty small, only around 800 million in market cap, and pretty long runway ahead for growth. And the company also historically repurchased shares opportunistically in the public market. And I think that is a very shareholder friendly policy over time. Uh, yeah, and that's on my end. What end do you have, Chris?
Yeah, so I have a name in the material sector, but just an interesting commentary on TVK is, being a name in the energy sector, it's interesting because it's so decoupled from the traditional cyclicality of the energy sector and different oil and gas companies. Like if we look at any other, traditional oil and gas company on the TSX, its share price is going to be much more volatile than TVK's has over the
Right.
years. TVK's really, done a great job of compounding its capital and keeping its volatility of its share price low by, all of its reinvestments and whatnot. Um, so that's another interesting, thing about TVK that makes it so different and kind of helps investors diversify away from the traditional cyclicality of the energy sector. Yeah, so I've got North American Construction Group. The ticker is NOA. So here I'm looking at the materials sector. Materials, it hasn't really been a top performer or a bottom performer over the past few years, but I feel like it's time to come into the closer to the forefront. Is likely coming close here. And so NOA is really a global provider of mining and heavy construction services. They've been in operations for over 70 years. They have a mobile fleet of about 1,400 heavy equipment assets. And recently it made a really large acquisition of McKellar Group, which is expected to boost its sales by 40 to 50%. So really good, meaningful recent acquisition that should help boost some of its fundamentals. And it operates in 3 countries, 11 different commodities, 35 key customers and projects. And it's mostly operating in the coal kind of industry as well as Canadian oil sands. Um, and one of its key competitive advantages is it's a low cost operator. So about 90% of its maintenance occurs in house. So it's able to internally remanufacture components at a lower cost. So it has about 10 bays for heavy maintenance and rebuild capacity. So that just kind of helps it to expand its margins and keep them high, which we can see in this chart here. So at the top, again, we have EBITDA on the last 12-month basis over the past 10 years. Um, some level of cyclicality there where it peaked in 2020, but nice up and to the right for them. They've done a great job of expanding EBITDA. Share price has kind of reflected that. And then looking at EBITDA margin, it's been hovering nicely in that 20% range for several years now. So, they've done a good job of managing their expenses. And then looking at sales growth over the past year on a rolling basis, it dipped into the negative territory a few times, 2016, 2021. But for the most part, it's able to grow its top line at a really fast rate, growing at 20% over the last year for the past couple of years, and then even getting up into the 50+% range, in that 2019 and before kind of time frame. And valuation wise, it's not too expensive. It's trading at, 0.6 forward price of sales with an average 10-year average of 0.5. So really, it's not too crazy expensive. Fundamentals continue to grow, and share price continues to move in the right direction. So yeah, hopefully we see 52-week highs with this name as well, and then we can add it to the list.
Yeah, for sure. Just a couple comments on my end. So as far as I can see, like there is inherently some cyclicality in their underlying business, but the overall trend growth in the last 5 years was around 19%. So it was very solid growth, um, and also just trading at like low single digit forward PE, I think is pretty attractive from here.
Yeah, definitely. Yeah, it's a name that investors can kind of see as being, relatively cheap, maybe even like objectively cheap compared to some other names, and also operates in a sector that isn't too frequently talked about, materials. So we see that as kind of an interesting diversifier. So next segment, we've got a fun one, a good one for the season that we're in right now. It's earnings season. So what do you got for first company that reported earnings, or at least group of companies, maybe?
Yeah, sure. So we are right now in the very first week of the earnings season for Q4 last year. And the Canadian market was pretty quiet in this period, actually.
Yeah,
Yeah, not many companies reported, but our neighbor market, the US one, has been pretty busy in the last 2 weeks, I would
yeah,
say. Um, and some of the highlights for the earnings season so far is the majority of large banks' earnings are pretty decent. Most of them either beat or meet the analyst expectation, like JP Morgan, Bank of America, Morgan Stanley. These banks are performing well against the economic downturn, and they are also trading at quite a cheap valuation. For example, Bank of America is trading at around only 1 times book value, and their returns on equity has been consistently around 12 to 15% on average. Uh, and it has been the quality of the US bank is not as high as the Canadian side, but I think given the valuations there, it's been pretty attractive. And going forward this year, I think the capital market and investment banking side of these large banks will see some acceleration in the top line growth as the capital market recovers, like more IPO and more M&A activities for corporations. So overall, decent earning season so far for the banks. And what how about you, Chris, on your end? What do you notice for the earning season so far?
yeah. No, definitely. And it's interesting. You noted the one of the bank stocks trading at 1.1 times book. I think that's kind of a key metric for most financial companies, especially banks, is that price to book metric, and seeing it near one for most of these banks, it's really kind of like a sign of the times that things are still cheap in that sector, and some of those names look pretty good right now. And historically, we don't see them getting below 1 times book too often. So, um, you know, buying around that 1 times book can be helpful sometimes. For mine, uh, earnings, I'm looking at mainly a single company, but in the coming weeks, I think we'll probably see more of these types of companies start reporting. So we saw Taiwan Semi, the ticker is TSM, kind of report last Friday, and that earnings result really kind of kicked off a little bit of a mini bull run in the semiconductor stocks. So, TSM can kind of be thought of as like the bellwether name for all of the semiconductor names. Most chip production really goes through them, through their chip foundry. It's like 60 to 70%, I think, of all manufacturing. And so they reported a massive sales and earnings beat. And then management noted Q4 business was supported by continued strong ramp of industry-leading 3M technology. And for Q1 2024, they're expecting business to be impacted by smartphone seasonality, but this should be partially offset by continued HPC, high-performance computing related demand. So management really saw continued strength in the AI kind of demand for chips. And after TSM reported, we saw a lot of those semiconductor names really start to pop. And then that kind of continued into this week. And so, yeah, it's kind of looking like that might be the trade that continues into 2024. So that's a good sign for, some sort of industry or some sort of sector to start, you know, reporting good numbers, reporting strong sales and forward estimates, and that kind of can sometimes lift the entire market. So yeah, it's always helpful to have that sort of secular trend.
Yeah, for sure. And we just comment that like TSM is like the leading name in the AI theme recently, and also we at FireEye we have been pretty bullish on some semiconductor names over the years. Like you and Peter has been pretty bullish on Nvidia last year, very early. SMCI too, and ASML. Yeah, we really like those semiconductor names. We think they are high quality businesses, generating very healthy cash flow and growing double digit. Yeah, we have been a big fan of this sector.
Awesome. All right. Well, we've got some upcoming earnings that we're watching. So, earnings season's here. We've got mega cap tech reporting next week. We have some large industrial names reporting this week. So we've got, 3M, Tesla, other large tech names like ServiceNow reporting. So those are always interesting to watch, get some insights from those. Kind of helps with justifying why certain stocks are owned or why an investor might own them. And then on the Canadian side, we have some upcoming earnings like, nothing really until early February, so still have a couple weeks there. And then middle of February is when it really starts to kick off for the TSX. But some of the names that, I think we're looking forward to reading more about and seeing the results of is OpenText, that's OTEX, TMX Group, that's the ticker is X, First Service, so kind of glean some insights into the real estate sector, Sun Life for insurance, and then of course always curious to see how CSU does. So
yeah, definitely. Yeah,
we've got one last section here. So today we're going to be playing guess this chart. So I'm going to have my co-host guess this chart, and there's no ticker name on it. There is the price, but that's all that there is, other than a line graph. So I'm going to put it up here and see what Michael can do, and then maybe I'll give you a hint if it doesn't work.
Like guess the name of the company.
Yeah.
Is it Canadian or US market?
Yeah, it's Canadian. Yeah.
It's Canadian. Okay.
All right, I'll give you a hint.
Yeah.
What name saw some really nasty drawdowns after earnings, pretty much over the past year in the
utility.
Discretionary.
Arisia?
Yeah,
No.
yeah, Theritia. Yeah.
Is that okay?
Yeah. So yeah, this name you can almost see where it had those earnings drops. We can see the volume. Jan 2023 and April, July, those massive gap downs in price. So yeah, this name had some troublesome earnings, but recently we've seen a good set of earnings and it's popped, so it's good to see. But that is the chart. Good guess.
Yeah. All right. Thank you. Yeah, it pops. I remember it pops like 30% in the last few days. So yeah, definitely
Right.
really strong momentum there. Yeah, the all of the as far as I can see, so sales is accelerating again, and the company seems to normalize its growth prospect from here.
Yeah, no, definitely. It's seems to be normalizing, and maybe that kind of turns out well for the consumer discretionary space at large. Hopefully, it's a sign of things to come that these retailers can start to normalize their inventories and stop putting things on discount, and that might help out on the earnings side. So
yeah, for sure.
Cool.
Yeah.
All right.
Cool.
Well, that's all that we have. That was kind of all the segments. So thanks everyone for listening, and hope that you enjoyed the episode. And then we'll be back for more. We have some other episodes that we'll be recording and posting over the coming weeks. So yeah, thanks again, and I hope to see you next time.
All right, thanks everyone.